Good morning, ladies and gentlemen. By my calculations, we are still around -40 in the risk dial, therefore quite deeply negative, but I'm not as negative on the market, on the risk markets, as the risk dial for the next couple of weeks. We have month-end rebalancing, which should be quite positive for stocks, and we also have then the ECB and the Fed in the early part of June, and I will now show you what I think about the bonds for the next 2 or 3 weeks, which is positive, which should support the market. The yield curve is basically dead. If we have a look at 530s on a weekly basis, it's moved, 1 basis point, and it's right basically at support. I don't think the yield curve is going to give us any clues over the next couple of weeks, not before the Fed, and I will also show you why. Inflation expectations are completely pancaked. We are basically now at the same level as we were at the beginning of the year. This is where we were January the 3rd, and this is where we are 2 basis points lower actually than we were at the beginning of the year. If we look at the 10s break-even inflation rate, that is also exactly where it was at the beginning of the year, 1 or 2 basis points lower. That to me means that there is absolutely no pressure for the Fed to do anything but the 50 basis points they have basically pre-announced, and therefore I don't think that the yield curve is going to do very much, and I think the individual tenures, which we'll look at next, are going to do anything at all but mean revert and basically wait for the Fed. Here we have the 5-year note. I think the 5-year note will trade here at 267, 268 over the course of the next week or so. And on the weeklies, you also see the pattern. I think this is the pattern that we're going to see. Several weeks of, a couple of weeks of absolutely nothing, trading just below, just above 267 with quite a bit of support there. If we have a look at the 10s, and these are now the 10s, the important levels are going to be here, 273, 261. I think we're going to see them. It's basically just mean reverting ahead of the Fed, which is a normal behavior for the bond market. Without the inflationary expectation pressure, I think this is by far the thing that makes the most sense. And if we look at the 30s, and this is the yield of the 30s, what can we expect? We can expect not much. Either we go down to 294 and stay there, or if things turn out to be weaker, we go down to 272. But that is not a big move. I mean, that's 15, 20 basis points. That's like 2-3 points on the upside. I think it's very, very unlikely that we test this 320 level again. I think there is no pressure at the moment, and I think a sideways move like here is far more likely. If we have a look at what that actually entails for TLT, I think it's far more likely that we trade around this 120 to 124 area, much like here, and do absolutely nothing ahead of it. In Europe, I can see no pressure now on the bunds, and in the longer part of the curve, I think that by the time we get to ECB around the 9th of June, we will be somewhere around this 76, 77 area. That is quite enough for that to happen. If we look at really the one that's even clearer is the French 10-year note, and really here we could come down towards this 126, 116 area. So I'm really positive overall. An ABC down and wait for the ECB around 116, 126. That makes a lot more sense to me than us trying to go even higher. There is no pressure at the moment, I don't think. I think the market is quite content to trade these yields, give or take 10, 15 basis points. My bet is this is where we are towards the end of the first week of June, around 115 basis points in France, which gives us a differential. If we go back, we will be somewhere around here, these yield levels, around 70 basis points in bunds. The differential between the bunds and the 10-year note is coming in, as I thought it would. I think over 200 is just unsustainable. I think we will be trading much the same here, around between 182 and 174. I really can't see this changing in the next couple of weeks, and that actually puts some pressure on the DXY. I think the DXY is running out of reasons to go higher, and we can see what that should technically imply for the level going into the Fed and the ECB. And here we have the Dixie. Don't forget that the ECB is a week before the Fed, and therefore I think the pressure to the upside is going to be less than the pressure to the downside. What does that mean? 101.92 I think should trade sometime next week, and then the pressure should continue to the downside for a few days. I don't think we break 100 spot 39. I think that is very unlikely, but it's also likely that the pressure remains towards that level. What does that mean for Euro USD? And that is the chart. You can see that every time, we basically tested this 103.40 level, bounced off it. What does the market do when it can't break a level? Well, it hunts for stop to the upside, and this is the kind of level that we are looking for. We're looking for around 107.50, 107.70, i.e. basically where we were when we broke down 2 weeks ago. If we go back to Dixie, where is that level? Where it's around here. Yes, and you can see these highs around here, and that would, sort of indicate to me that 101.74 will trade over the course of the next couple of weeks. What is 101.74 here on this chart? Well, it's just below this level here, so we're going to be mean reverting and trading around these levels. If I'm not expecting pressure on the bond yields, and I'm not expecting pressure on the dollar to the upside, then I really cannot be bearish of gold. I think gold will trade again at 1881 over the course of the next couple of weeks. I think it's completely run out of steam on the downside, and you can see that we have we are turning positive on the MACD on the dailies, and also we could easily get to 60% on the RSIs where we've bounced off this 30 level. That indicates to me 1881 should trade at some stage. I really don't see any pressure on the downside in gold over the next couple of weeks. I don't think it'll go up very much. I think it's going to be a sideways market. I think you buy dips down to 1830, below 1830 to around this kind of level, 1815, to resell it 1881. I really don't see any pressure on gold over the course of the next couple of weeks. DBC is doing absolutely nothing but range trading. Now, is that bearish or bullish? Well, we need to wait for a break, and it all depends on CL. In any case, we have a lot of resistance up here at 29.73, but the fact that it just will not go down is actually quite worrying. In any case, what I'm looking at is this relationship between DBC and GLD, and if all the pressure is to the upside on DBC, I really can't see any pressure on the downside to gold, given where this spread is. This spread is saying that gold is cheap relative to DBC, and if DBC is going to have upward pressure, I also expect no downward pressure on gold. I really cannot see what the harm can be in buying dips in gold over the next few weeks and just sitting there, with gold at good levels. I don't think you're going to lose very much at all. Copper is a very interesting chart. Let's enlarge this weekly. It never closed below this 4.1735 on the weeklies, indicating really that it's still going sideways but opening up these Bollinger Bands, and will be ready to make a move in 2, 3, 4 weeks time. And the implications are interesting. If the break is to the downside, that means demand destruction, and that means that really the whole DBC complex, all the metals, energy and everything should break down at some stage. If it returns, that means that the pressure of the pricing pressure is still there. Very interesting chart that says that maybe nothing is going to happen for the next 2 or 3 weeks, but when it does happen, it's going to have important implications for bond yields and the price of gold and the price of all assets. What we have to do is wait and try to figure out which way it's going to break out, but this is really something that I keep an eye out on every day, all the time, because the implications are going to be very significant. And the other chart that we have to be very conscious of is CL. We haven't broken on a monthly basis. This is a monthly chart above 113.89 for a long time. This is going back to 2012. I think that if we close a month above it, we are in for a spike certainly into the 150s and possibly quite a lot higher, and that could be really the thing that completely kills the US consumer. I will show you later how everything in the stock market that's been going on for the past couple of weeks is really about the US consumer, and this is what worries me most. I hope it's not going to happen over the course of the next few weeks. Who knows? But it's certainly the chart that gives me the heebie-jeebies about a much higher level of oil, which will have implications for absolutely everything. You will have noticed over the course of the past 10 days or so that really the only stock market that's consistently weak has been the US. And that has been simply a factor of XLY, i.e. the US consumer is getting re-rated, that their possibility to purchase and to continue the expansion has been re-rated, and XLY has been completely destroyed. We were trading a good 30% higher only 2 months ago, and really the destruction in XLY has been very significant. XLY and XLK being such huge components of the index, they have basically made sure that the index could not rally. I think this is probably coming to an end over the course of the next couple of weeks. We are the 200-day moving average. We've done the ABC correction, minimum target of 100, and we bounced a little bit on Friday. But we are very close to coming back to 124, which is back to where we were before COVID, and very, very important support. I would be shocked if we even got there or broke down through that level over the course of the next 3 or 4 weeks. I think bounces are far more likely, bounces that will be sold again and probably arrive at that level when everybody is, when a recession in the US is very much discounted and everybody agrees on it. At the moment, we don't agree whether there's going to be a recession in the States or not. And the data certainly does not indicate that there is one or that one is imminent. But the market is a discounting machine, and it's already discounted 80–90% that there will be a recession, which basically means that anything that, any kind of data that shows that there won't be one is going to bring XLY back to 155, something like that. And that means that we are more likely to rally at some stage in SPX than not. And this is XLK. If we enlarge this weekly area, we can see, 1, 2, 3, 4, 5, 6, 7 weeks down, and it's basically going down at the speed of the Bollinger Bands, of the weekly Bollinger Bands, a little bit below, a little bit above, but basically keeps on rallying to it. I think it's very, very unlikely that we do an 8th week red, but even if we do, it's going to be very little red because it keeps on bouncing up and down along that line. To me, this indicates that mean reversion over the course of the next couple of weeks is actually more likely than a continuation down. And if XLY has already discounted the US consumer being weak, and if XLK has already discounted higher yields and adjusted to it, I think if bonds do literally nothing, i.e. just go sideways, there will be upward pressure on both, on all these sectors, and therefore the indices to do slightly better ahead of the month end, where you're going to have quite significant inflows into equities as a result of rebalancing, and also just mean reversion ahead of the ECB and the Fed. This is a weekly chart of XLY over SPY, and you can see how absolutely straight down this line has been. How over the course of the past 3-4 weeks we have basically re-rated the US consumer, and we are now at the same levels that we were in 2014. To me, it's unlikely that this continues straight down. I don't think the odds are high, and I don't like playing things which are not high odds. To me, the reason why SPY has been going down so much relative to Europe, to Japan, is XLY, is the US consumer. Basically, the market has said the US consumer is finished. It's not going to be able to absorb all the price rises, whether it be in oil or this or that. Well, without a next level rally in CL, when it goes another 10%, I think the move here is probably pretty much done until we get the Fed. I think we're much more likely to mean revert a little bit than we are to keep on going straight down. And in that case, that is supportive for the indices. This is SPY over FEZ, so basically Europe, but in dollar terms. And you can see basically that we are mean reverting. To me, it's terribly unlikely that we just keep on going down. these kind of levels are going to be very, very good support, and you can see the direction of the moving averages. Basically, this move down has been the US consumer. Why has Europe not been hit as much in the past few weeks? The US consumer, XLY, nothing else. That is just a question of the composition of the indices and the fact that the US is much more tech and consumer stock oriented heavy, and therefore we have had this move. To me, this is running out of steam. If I'm not expecting the US dollar to start going up a lot, then I have to, and in fact I'm expecting the contrary to happen, and therefore I would have thought that this move is very close to done, and therefore now the correlation between Europe and the US is going to be far more in favor of the US than Europe, and therefore I would have thought that this is coming to an end very, very soon. Okay, so coming into month end, let's start off with a monthly chart of SPX, and really what I wanted to show you here is that every time we go down below the red line in the monthlies, we find support at the monthly Bollinger Band, but also we spend several months going up and down. And that is not a wonder of technical analysis. It just basically tells you that the market discounts something, and then before it can go further and discount something else, it needs some data to confirm what it has discounted. So if you have a look at all the bear markets that we had, whether it be 2000 or 2007 onwards, the market has several months of hesitation below that line. In this case, if we enlarge this, what does that entail? That basically means that we have several months of hesitation here between 3500, 3621, this kind of area, and the top of this red line, which next month is going to come down to 41.35, something like that. That's going to be your range for quite a few months before we decide which way we go next, whether fears of a recession coming in, whether it comes last quarter this year, first quarter of next, the market's not going to care, and then it's going to go down. But it just shows me that any kind of hoping for some kind of a crash over the course of the next month or so is silly. This is coming up, and it will be in this range next month. So to me, the bottom for the next several months is going to be this 3500, 3621 area, and the top is going to be around here, around 41.25 or so area. On the weeklies, you can see much the same thing, but with slightly different levels. To me, the top is likely to be on the weeklies 42, 47, that kind of area. I don't see it going up any more than that. So any bounces, I think, are going to be limited next week, but this kind of level, 41.20, very close to where we were at the top of the of this week before we came down and discounted the XLY. To me, XLK has a possibility of dragging us higher towards these levels, and we'll have a look at NQ to confirm that. But I think that the likelihood that we are in a trading range between these levels is far higher than we get a continuation move, certainly in the next 2 or 3 weeks. And my favorite 195-minute chart basically says the same. Flattening Bollinger Bands on the downside, good support, but very, very good resistance here at 40.68 for next week, or possibly up to 41.29. I really don't think that we can break that. All the moving averages are rolling over. XLY is going to rally, XLK might rally, but it's not going to enable us to go much higher than these levels. There is no reason for it. There will be plenty of sellers on any decent bounce. So it's just a technical sell-off. There's no, every time we go through the lower Bollinger Bands, it bounces, and it just shows you there's no point in trying to force it below those levels. It's trading very well level to level. I think next week we might see 40.68, and I think that's going to be a decent sell level for that week. The fact that volatility closed below 30 again on Friday, given, that we were just about at the lows for the past X months, indicates to me that the market is just not ready to go down at the moment. It's far more likely that volatility is going to come off in the early part of next week down towards this 25 level, from where we can possibly do another move higher. But it's now just about filled every gap that we had. So the pressure on the upside, I think, is going to be, in the upside of volatility is not going to be very great. I think it's far more likely that we come down and allow the SPX to go up to 4,000 and 4,030, those levels that I showed you. And here we have the monthly NDX. You can see how close we are to the Bollinger Bands. NDX has done far more work than SPX, and SPX has caught up now with the XLY move. I think this is very close to interesting levels, around 11,000. And I think this is an 11,000, 13,000 market, what you want to do for the next couple of months. On a weekly basis, it's obvious we've reached the 50% retracement of the whole move up. We've had 7 down weeks. Would it really be surprising if we went sideways for a few weeks and tested back up to 13,000, which is basically where all these lows are, and also the 0.382? No, I really don't think so. So if I don't see any pressure in the bonds, it makes more sense to me that XLK is not going to have huge pressure. And if XLK doesn't have any pressure, then it's unlikely that with stable yields and the total crap out we've had in XLY, that just continues unless we get a huge move in CL. And that's my joker in the pack. It's more likely to me that we spend a couple of weeks before the Fed and the ECB retracing rather than continuation. Europe is sideways, and it's just the factor of the dollar and the bond yields and the bond differentials that is going to make this continue to go sideways. If we enlarge this, and don't forget that for the past 8 weeks we've had the SPX go down a hell of a lot. And what has Europe done in the past 1, 2, 3, 4, 5, 6, 7, 8 weeks? Well, not very much. The pressure is still to the downside, but I would have thought that this kind of 36.24 level, it keeps on bouncing from it and not really moving a million miles away from it. So if we say that Europe is going to stay at 36.24 roughly over the course of the next couple of weeks, or revisiting it constantly, that should mean that there is 1, 2, 3% pressure to the upside in SPX. I really wouldn't touch Europe. Below 36.24, it doesn't want to go and stay. It keeps on bouncing. And really, this kind of level, 38.82, is a massive sell in Europe. And anytime I see anything close to it, I'm really going to take a very large option position. I've updated all the levels. The only thing that I'm scared of over the course of the next couple of weeks that could cause a continuation in XLY or make the bonds start going higher in yield is a spike in CL. That is the only thing that I'm worried about and that I'm really looking hard at. Otherwise, I think the likelihood that we get bond stability and retesting of these levels is much higher than we get a continuation move to the upside. Therefore, that is it. I'm just watching CL and making sure it doesn't break those levels that I spoke about. But otherwise, I'm looking for a slightly weaker dollar, 1-2%. And I'm looking for the stock market to recover 3%, something like that, over the course of the next couple of weeks, and go sideways until we get some data that confirms that the US consumer is really screwed. I think we will get that data, but it's far too early to gamble that that is a fact, as opposed to the market discounting the possibility. Thank you very much indeed, and tweet you on Monday.